Well, there's an old business adage that what gets measured gets managed. But in the age of climate risk, what happens when what's measurable isn't what matters and what matters can't always be measured? Well, this week on the Monocle Banking Podcast, we're diving into the green ledger, where climate, capital, and credibility all collide, from a $213 billion annual financing gap that Africa faces to a lot of the politics that are reshaping global sustainability norms. My guest is Yaseen Lockhat, who's a senior specialist for sustainability at the Banking Association of South Africa, BASA, and he's been helping steer the sector towards a future where climate and nature aren't peripheral, they're central to financial stability and growth. So how do we move from net zero promises to a more balance sheet reality world? How do we price risk? How do we mobilize capital? And how do we still keep the just in the just transition? Let's open the books. Yaseen, welcome, and I must say, great to have you on the podcast. And Africa's banks sit at a very fascinating intersection, don't they, in all of this, between the climate crisis, capital scarcity, global commitments and local realities. And recently, you facilitated and were part of the high-level dialogue on advancing climate and nature capabilities of African financial institutions. Firstly, what was that all about, the dialogue, and what was the main thrust and focus? What brought you all together?
Thanks, Michael. Thanks for having me. So the dialogue is actually a partnership between the UNEP-FI, if you're going to venture into the abbreviation, common in the sustainability world, but UNEP-FI, the United Nations Environmental Programme Finance Initiative, Standard Bank, Banking Association South Africa, and the SADC Banking Association. What we were looking at is climate risk as well as nature risk and how banks and corporates at large can, let's say, respond to these risks. Understanding that a lot of our South African banks are advanced in this journey, while the rest of SADC is probably at a less advanced place. So we, in partnership around the G20, thought it's a good idea to host this high-level dialogue where we, talk about the journey to date in the South African banks, but also providing a platform for the other banks to hear about this journey so that they can start their journey.
And it's interesting that, as you say, we are playing such a leading role regionally, because I think often the debate and the discussion at a global level, when you have the UN conferences, the IPCC, science tends to inform them, but at the COP summits, it's a lot more political. And often it's about who pays, the global south demanding more from the global north, because the global north benefited from decades of industrialization using fossil fuels. But before we get into some of the kind of real politic of it all, let's maybe just start at the why. Because when we talk about equipping African banks to integrate climate and nature into their decisions, what does that actually mean in practice, and where are we still missing the foundational capabilities?
Sure. So at a basic level is trying to understand, what the impact of climate change is on your portfolio. I think the big worry for Southern African banks is that we warm at the rate of twice the global average. So if the global average is 2 degrees, we'll warm at a 4-degree rate. So you have that issue, and you'll see a lot of the, primary activities that the banks lend to in this region are impacted by climate change. Right? So that is almost your starting point. I think where the gaps are, it's a common one. It's around the data challenges, a lot of the data challenges. And then at a latter point, it becomes a very technical conversation on how do you, once you have that data, one of the big challenges with climate change is that, you can't go off historical projections. It's a new territory. So it's a lot of modeling involved, trying to understand the impacts, as you referred to the IPCC. It's taking that, if I can call it, the climate science or the nature science, and translating that into financial metrics to understand how it impacts your bank.
And I mean, that's really now where we start to become a bit more operational in those financial metrics. And I've always wondered whether, say you've got a target by a bank or financial institution to reduce exposure to fossil fuels. How ideally should that be expressed? Do you express that as a percentage of the overall group loans, the book, or is it an emissions intensity measure? And my issue with using an intensity measure is that you need to really understand the underlying actual spend of both the numerator and the denominator. And so your fossil fuel exposure might not change at all, but you actually increase your loans in other ways, and that percentage would go down, but it's not really reflective of progress with carbon emissions. So these things actually become quite tricky when you get out into the weeds of it.
I think you're correct there, Michael. It's a very tricky process. And I think, one of the other challenges for a bank is that they lend to a number of intensive industries, if we can call it that. So how does the bank decide, which industry it's going to withdraw from or lessen its emissions intensity, and, which one it will keep steady? So that's a very tricky conversation to be had. And I think, part of the conference and what our message that we as a banking association are trying to get across is that often you need a national plan that can then filter down and can be used by the banks to inform, their net zero targets. And I think it becomes a much more easier conversation for the banks to follow. You don't want to end up in a situation where at a national level, the country is pulling in one direction and, the banks are trying to meet Paris goals, for example.
Yeah, no, exactly. And that's why we see the Reserve Bank is trying to drive the taxonomy and to ensure we all sing from the same hymn sheet, I guess. Let's talk about that data, though, which is the backbone of credibility, I think. How do we get to that standardized carbon accounting and scenario analysis, those frameworks that are usable for African banks that potentially might not have the resources of a JP Morgan or HSBC?
Yeah, so this is one of those issues that, we're all trying to work together to address. But I think that you're not going to solve it at a bank level. And what we're trying to encourage is that this data is being collected at the corporates, or even there's a lot of push to get this data at an SME level as well. So trying to get those data that can filter up and also trying to make that data more accessible. So we have a platform with National Treasury. It's a public-private partnership. The previous iteration of this platform was called the Climate Risk Forum. We're now expanding that to what we call a Sustainable Finance Initiative. And in this platform, we're going to look at the data issue.
On that, there is obviously global taxonomy, shall we call it. You've got IFRS S2, which are climate-related disclosures. And as you said, there's lots of acronyms and alphabet soup here when we get into the sustainable finance world. But it's the International Financial Reporting Standard on Climate-Related Disclosures. It's been issued by the International Sustainability Standards Board, the ISSB, and it really sets a global baseline for how companies and soon banks must report climate-related financial information, so that as an investor, you can at least compare apples with apples across markets. And it's built directly, I think, into the Task Force on Climate-Related Financial Disclosures, which is the TCFD. So I had to get those out there. How are local banks preparing for IFRS S2 and these TCFD disclosure requirements? Are we seeing sufficient board-level understanding of climate risk?
Yes, we are, Michael. I think BASA, we had our first training on the TCFD back in 2019. I think the first few banks to report on the TCFD must have been in around late 2020, 2021. So annually, the banks are producing no longer TCFD reports, since TCFD has now formed part of ISSB, but they are producing reports that still contain the information for TCFD, either in the sustainability report or the environmental report. So we're seeing that come through strongly, in particular in the big six banks. In fact, South Africa is probably one of the country with the most coverage in terms of, let's call it TCFD reports, because all our big six banks have these reports, so that covers about 90% of banking assets. In addition to that, we've seen that the Prudential Authority released two guidance notes on climate risk disclosure and climate risk management, which again are aligned to the ISSB S2. And we're seeing also that coming through the reports that the banks are putting out.
Right, so lots of work going on. And I think one of the hardest parts of IFRS S2 is quantifying scope 3 emissions. Those are those indirect emissions that are buried in your loan portfolios and supply chains. How do we build the data infrastructure to make that possible in the African context?
Yeah, so Michael, it goes back to that issue around, this is data that we need from clients. It's data that we need from the portfolio, which is tricky. I mean, I must say at the high level, at Dialogue, we had PCAF, another acronym. So it's a Partnership for Carbon Accounting Financials. and they provide the methodology on how you can obtain these, emissions for different types of, for your portfolio. Let's say if you have vehicle finance, how you can try and estimate that, and they provide a whole methodology around that for real estate, for example. So, we said that primary data is not always available. So there's other ways of navigating that. But we as an association, what we try and do is we try to speak to the other associations in the real sector economy, try and have that conversation to why it's important for that data and important for the banks to get that data. But like we said, it's not always available. Then you can rely on PCAF, for example, that will provide you alternative methodologies on how to estimate that Scope 3 emissions.
Another acronym. Well, there we go. But I think, often, and that's sometimes the critics point to this, sustainability, sustainable finance, net zero as spawning almost a cottage industry. And we've got acronyms, we've got frameworks, but where are we actually seeing this move the needle? So once the first wave of IFRS S2 aligned reports starts landing, what will success look like to you, Yaseen? Is it just greater transparency, better risk pricing, or are we seeing actual capital shifting towards greener projects as a result of all of this?
So I think we tend to focus on the risk element quite a bit, which I think is important. In particular for a country like South Africa, that, we mentioned the physical risk which we're exposed to, but also I think earlier you mentioned the just transition, so the transition as well as the social risk associated with climate change. But I think we tend to maybe focus too much on the risk. There's a big opportunity in sustainable finance on the product side. So a lot of products, new products that are coming out, sustainability linked loans, sustainable bonds, sustainable loans, green loans, green bonds. And that also then ties into how it could be a potential growth area for the country, but it can also solve some of the fundamental issues that we are faced with. South Africa had our electricity crisis, and we've seen that renewable energy there was a big boom, but there's also opportunity, for example, in water. And I think that's a place that we often overlook. And I think there's the big opportunity in South Africa. So it's in the product side, but also using those products, to put in an alternative water system, for example, or water efficiency, energy efficiency. And I think that's a big opportunity.
I like that framing of it as not just a risk, but an opportunity, because I think often critics worry that climate disclosure frameworks risk just becoming a tick box. But you're talking about, well, let's help banks compete and innovate rather than just tick boxes here. And, we've seen the recent announcement last week of the EU's 11.5 billion euro. I mean, that's a lot of rands. It's 230 billion rand pledge to South Africa in our just transition. It's massive. Obviously, we've seen pledges before. What do you make of the structure of this investment? Particularly, we've got, I think, 8.7 billion euros in blended finance. And how are you working with the regulators and the DFIs to ensure, as BASA, that climate funding addresses all of these issues that you just mentioned, like water and so many important issues for the South African economy?
Yeah. So, Michael, we work very close with the DFIs, with the IFC. We have a program with the IFC called the 30 by 30 Zero program. And there we're looking to, we support banks with, training on, for example, climate risk, but it's also having these conversations, and I mentioned it earlier, with other industry associations. So, for example, with the agriculture, with Agri-SA, we recently signed an MOU to look at sustainable finance and also how do we increase the data in that space. We understand that oftentimes, farmers are adhering to sustainable practices, but how they approach it or how they frame it is not in the sustainability sense. So it's uncovering those aspects and then using that to look into great products or synergies that we can help build on. But in particular on the international finance, I think the important thing from a South African point of view is that we preferably would like to see this come in at below commercial rates so that we can leverage our own local market and our own domestic capital. I think a big risk is the currency risk associated with these international deals.
Always, when you're dealing with Africa, we have to deal with currency risk. There's also the geopolitical risk of the moment. And I want to talk about how you're using technology and AI and data and measurement. But we've seen US banks exit the Net Zero Banking Alliance after Trump's policy reversals. We've seen Tony Blair calling the current net zero strategies doomed to fail. How should African financial institutions interpret this Western backpedaling? Does it create space for African leadership or does it risk another funding cliff?
So in our view, Michael, I think it's definitely an opportunity for us. I mean, when we had a big focus this year on Africa, and like we had the high-level dialogue that wasn't only focused on South Africa, we looked at SADC. We had another event earlier in this year also looking at the region rather than South Africa as well. So we do think it's an opportunity. We think that, like we said earlier, we have to look at the opportunity of this. And again, just to reiterate, Africa is at the forefront of the climate issue, and these issues could potentially exacerbate our socio-economic issues. So we understand the geopolitical shifts, but I think that's not putting us off. We understand that we need to do work in the space, and this allows us an opportunity to own the space. So the Banking Association is part of a global platform called the Sustainable Banking Finance Network. And if you just look at the reports that comes out of the SBFN, another acronym for you, you see that emerging markets are thoroughly still embracing sustainability, and they're rolling out frameworks across climate, nature, and the social as well, because these issues are important to their economies and to their countries.
And I think often if you're going to continue pursuing these strategies, then one requires local political buy-in from citizens. And trust is currency, I think, in sustainable finance. So how do we avoid greenwashing or equally green hushing as banks scramble to prove their climate alignment while managing some of the commercial realities on the ground? For example, as we know, it would be foolhardy for banks to just stop funding coal, for example, in a country that's been so severely impacted by load shedding, where it still makes up just under 80% of our energy mix. There are the realities of the day. So how does one manage that transition?
So I think, Michael, we go back to what you earlier said also around transparency. So it's been very transparent on how you communicate, what you're planning to do to customers, but also I think we moved away from disinvestment. So there's a big focus on how do you work with clients and corporates that are in, let's say, the intensive sector to try and green their business. I think an interesting space also that's coming up, which speaks to more the retail base, is the intersection between climate and financial inclusion. And we're seeing a lot of examples in Africa where, there's sustainability products are no longer just offered to corporates, but trying to mitigate the issues where, retail clients are impacted by climate change.
And I've got to come back then to the data, because I think this is an area where we must see a lot of innovation. Surely technology and changing the way that banks can assess, price, and monitor sustainability performance, because you can now use satellite data on land use. So you've got AI-based emissions tracking. How are you seeing the new technologies being rolled out in the way we measure our emissions and the way we start reporting on the various scope 1 and 2 and 3 requirements?
Mm-hmm. So I think emissions, scope 1 and 2, that, there's a lot of technology now that can measure, your performance of a building, electricity, energy, water efficiency. That's become, very easy to measure. I think with scope 2, with fleets, just, having the model of the car and getting that data, that also becomes a bit more easier to measure. But I think it's interesting stuff. So what we were recently exposed to an example in East Africa where farmers are taking pictures of their cattle and they're using AI to register each individual, let's say cow if it is, or bull, whatever it is, and then using that, as a collateral, as an asset that can be registered for finance or for insurance.
That's fascinating.
I think that's more of the niche, interesting things you can do with data.
Yeah, and it just shows you where we can innovate again, where we can use this as an opportunity. Just lastly, where are you seeing the most promising examples of African banks embedding this climate and nature risk into their credit decisions or their product design? Are there any case studies that really give you hope?
Yeah, I think it's an African example that's quite interesting and fascinating is in the affordable housing market. And you're seeing that, the developers are moving towards a greener model. And I think what it demonstrates is a savings for all. So there's often a misconception that it's more expensive to build a green, and that's been disproven. I think also then you see the benefit to the individual that's occupying that house, either as an owner or as a renter, because they have reduced utilities. And sometimes that also translates into a customer that's better able to repay, their bond or their rental. So that there is a classic, win-win that I think is a really great example.
And I do see, though, many African banks say that they're ready to finance green projects, but often the complaint is that there simply aren't enough bankable deals out there. Is that a fair critique? And do you think that's a failure of project preparation or risk appetite or policy clarity or certainty?
Yes, definitely, Michael. I think it's let's say climate is not mainstream yet, and that's why we're not seeing it in project preparation. Sometimes it's fundamental issues before climate change as well, and then you're adding a layer of climate that makes it more complex. But we're seeing a lot more effort being, put in that space, and that's why we also like to partner with other organizations where they can assist and they can come in with their expertise to try and clean those projects. I think there's a lot of work being done by the PCC. We having conversations with the Department of Forests, Fisheries and Environment to see, they put in out policies around, the NDCs and how we can bring down our emissions. But what's been missing often is that this is not accompanied by how we're going to make that viable financially. But we are having those conversations now.
Just a last one for you, Yaseen. The young banker listening today who wants to make sustainability their career path, what's your advice? Where do they start to make the biggest difference?
Michael, we're at the time where we see that, the world is changing. There's a lot of shifts that's happening. We need to become more resilient, if I can say. And I think that we have to be innovative. So, sustainability, I think I'll go back to what I said earlier in the podcast. We're looking at, we become stuck in this risk mindset. And if you really want to be innovative, I think sustainability offers you a great space to move from, that short-termism that we previously stuck onto a more long-term view on how we can change the world. And I think that long-term view is really a great space to be in, because the connections and what you can foster over a longer period of time means that there's buy-in, there's trust, there's accessibility. Yeah. And I think that's something that we need to put a lot more focus on.
It's interesting you mentioned that. It's where I'm seeing the model most effectively deployed at the moment is in private equity, which operates in much longer cycles than quarterly reporting or half-yearly reporting in the listed space. But that's where we're going to have to leave it for this edition of the Monocle Banking Podcast. My thanks to Yaseen Lockhat from BASA for bringing some much-needed substance to a conversation too often trapped in slogans. I'm Michael Avery. Thanks for listening. Subscribe wherever you get your podcasts. And remember, I think in banking, as in life, the real interest lies in what compounds over time.